The S&P 500 daily chart in DeMark looking back to end of December 2021. I'll zoom into the current area now. The S&P 500 daily chart has printed the combo and sequential sell setup 1 count, and to negate that for end of day on the 30th, there must be a close below 3844.82 for the price flip to the buy setup count 1. Price made it above the conversion line with help from the falling conversion line, and the 50% disqualified momentum down at this level is in danger of becoming qualified with a close end of day below this level. Underneath there is the ongoing demand line 3767.19, and trend factor disqualified down 3 for support. And the S&P 500 daily chart is in this tight range here. You can see a couple for a raise above the disqualified down 2 for trend factor. So that's the top of the range, and let's call the bottom of the ongoing demand line or trend factor down 3 the bottom of the range. The NYA top caller chart will look at the NYA to SPX ratio, basically value versus growth, to see that growth had its day in the sun for today, but not by much. The ratio's at 3.96. Yesterday it was as high as 3.98. The New York AD line is trying to push up against the top of the descending broadening wedge pattern here. And NYA price did make it back above the green support and resistance level here and pushed right up against the top of the measure rule from B to C and moved over. You can see the blue line right here. It's pushing up against that, break through that, and then we have a downtrend line here to get through. And the bottom fishers came in and picked up what the tax loss harvesters jettisoned yesterday on the 28th. But mostly the up move today was from the initial jobless claims, where bad news was good news, meaning bad news for those filing initial jobless claims and good news for those that are throwing money into the capital markets. Last month there was 216,000, and then this month bumped up to 225,000. Same thing with the continuing jobless claims, 1.67 million last month, bumped up to 1.71. So bad news is good news there. Bad news for those who are still looking for a job and can't find one. And good news for those who are throwing their hard-earned money into the capital markets. And looking forward to next week, January 6th, is the non-farm payrolls report. So that will be the big report for that week. The NASDAQ 100 monthly chart NDX shows that price nailed this long-term uptrend line going back to 2010 and then retreated. All that happened today on the 29th, and it came to rest above this green support line here, 109.44. There was a close of 109.51.05 today. And the NDX monthly AD line indicator shows that it nosed right under the lower line of this falling wedge pattern here. So I was able to make it solid. I had it dashed blue. So if the NDX AD line happens to be below this bottom line for the falling wedge pattern, when the recession is called and happens to coincide with the SPX monthly chart being under its dashed brown line here, when the recession is called, then that would mean that we'll probably go into a secular bear market versus the primary bear market. So that would mean a hard landing and a very rough recession versus the soft landing that everybody is talking about. You can see that the S&P uptrend line for the AD line has already been broken under, unlike the monthly NDX here in brown. So if it makes it underneath this lower line of the falling wedge pattern and gets under this uptrend line for the AD line, well, that will be the topper, but unnecessary, as we're looking for the S&P 500 to get under its AD downtrend line in dashed brown here. That's the one that really matters. If the NDX monthly gets under this falling wedge lower line, then that's really probably the harbinger of the secular bear market, depending on what the S&P 500 does. So that would be a definite heads up. The ROC 1, ATR2, and PPO Extreme chart shows that the ROC 1 has been going under the green zone here. So -1 a couple of times here, +1 a couple of times here. So the volatility, while not extreme these past few days, is still present. Although there have been instances of going under -2 here and +2 up here. So from euphoric state to extreme pain threshold. And you can see that the PPO Extreme chart came up for error a couple of times here in December, and maybe once for a little gulp of air in November, but it just promptly went right back into the negative section. So PPO Extreme is at -3.521 now. And you can see that from the beginning October to the beginning of December, the percentage of stocks in the S&P 500 above their 20 simple moving average was doing very well, mostly 80% up to 90%. So this is what you want to see here. Then it fell out completely and went right down to the basement, not as far as the other dip here. And now it's fighting its way back up to the equilibrium line at 50. The daily AD line did heave itself over this support and resistance line here. It's been mainly resistance for the most part, so that's a good sign to get above that. And it went above the 21 EMA signal line. You can see in the thumbnail the line in red here. So that happened today. Let's see if it can stay above that. A couple of days ago it did the same thing and fell right back out. And you can see the MACD over here in the thumbnail straight down, and today it hit the brakes and trying to pull back on the stick and head up. The signal line isn't too far away, and it's at -14. And the MACD is at -29. It'd be nice to see a crossover close to 0 and then head up. And RSI 14 is trying the whole mean reversion bounce going on here. Came down to about 40 here, came down again to 40, and it's bouncing up. So let's see if it can get back above 50 and its 21 EMA signal line, and we can call that a nice mean reversion bounce. The S&P 500 support and resistance levels big board chart shows the gray areas at the pivot point and the baseline 26 bars back concerning the lagging line. Price in the aftermarket hours for the S&P 500 at 5:37 p.m. Central Time on the 29th is 38.43. To the downside is the conversion line and then the weekly channel 3 low. To the upside is R1 at 3869.83 and then the daily horizontal support from 01/26/2021 at 3874.12. And price for the S&P 500 daily chart is about 50 points away from getting back to the Fortress Fed resistance line from 07/07/2022. And there is definitely a wall of resistance big time right around it. Weekly baseline 3908, 100-day simple moving average 3905. Top of the cloud 26 bars back concerning the lagging line 3908. The top of the cloud at 3906. The daily high channel 3 at 3905 and a daily qualified supply projection at 3910. And right above that is the monthly support and resistance line 3918 and the 20 simple moving average at 3916. And this should stay like this for at least the next 3 days, as the daily high channel 3 will be at that level for 3 days. The top of the cloud 26 bars back concerning the cloud lagging line will be at that level for about 3 days. And if anything changes to the upside or downside, I would say it'd be the daily high channel 3, but I'm sure it won't be by that much. So if price starts attacking this Fortress Fed resistance, I will be adding to shorts as soon as it starts approaching 3900. And if S&P price does manage to force its way into the 3900 zone, then the rules will come in for buying, and that's 2 or 3 closes above the Fortress Fed resistance. Each close must be higher than the previous close for a total of 3 higher consecutive closes. So that's the close underneath 3900 would need to be higher than the close previous to that. And then if it lurches into 3900, there must be 2 consecutive closes higher than each other here for 3 consecutive higher closes. And here's the S&P 500 downtrend line that has the right angled and ascending broadening pattern in blue here. You can see the blue line headed up, and the horizontal line here at 3900, the daily Fortress Fed resistance. And I did not do any buying here, as it did not satisfy the rules that I just talked about. I'll zoom in and we'll go over it, and I'll let you look at it and go over this area here. But starting here at the breach above the Fortress Fed resistance at 3900, there was not one instance of 3 consecutive higher closes. You can see that the one right before the breach, it's higher than that, but the one before that is above the close here, so that didn't count. And you can look in here and see that there were no instances of that.